This is Money Untold. Before we break down what just happened in Shanghai and its impact on global markets, make sure you follow us on X or Money Untold and subscribe on YouTube for full analysis.
It's not for everyone, just the ones who actually want to be early. Now, let's talk about what China woke up to. Shanghai silver futures opened at $99. That's the number. Western spot going into that open was sitting at $88.50. The physical demand signal from Shenzhen recyclers we discussed in the last video, bids running $5 or more above the SHFE pre-holiday close. That wasn't noise. It was the market telling you exactly where physical demand was priced before the exchange even turned on. Shanghai opened at 99, pushed all the way to $102 per ounce, and then closed the session at 96. One detail on that session close. The average was 96. The final physical lot reportedly cleared at 102. Whether the average or the final transaction better reflects true demand is a legitimate debate. But both numbers are above Western spot. That's the part that matters. That is a $10 premium to where Western spot is trading right now at $86, $10. And Western volume during the Shanghai session was almost stalled. Low volume, heavy premium, physical bids running well above paper. That disconnect is not accidental. It's structural. Now for the short-term tape readers, this is strictly educational, not a signal, not advice. This is about reading structure in real time. In the last few videos, we mapped out one resistance zone, 87.20 to 89. Price has now rejected that zone 3 times. Still no displaced, violent hourly body close above it. Price is currently sitting at 86.40 on Western spot. That's back below the zone. 3 rejections from the same level, no decisive break. That is how you read the tape. The zone is doing its job until proven otherwise. Watch for a forceful hourly body close above 89. Not a wick, a body. If you're getting value from this and the tape, the data, the bigger picture, 3 words in the comments. That's how I know who's actually here and paying attention. Back to the broader picture. The COMEX implied volatility index for silver options is now at 134. When we talked about this in the last video, it had just broken above 100. It's now at 134, beyond the highs seen on January 30th when silver spiked to $120. This is not a normal reading. This is the options market pricing in the possibility of violent, potentially disorderly moves that the current price action is nowhere near reflecting. Both the SLV volatility index and silver futures options, implied volatility are pointing in the same direction. Sharp upside price risk. The price is suppressed. The volatility index is screaming. Those two things cannot coexist indefinitely. And then there's what happened on the SHFE today specifically. The exchange suspended another group of accounts for breaching trading rules. That brings the total number of accounts suspended in February alone to 23. We watched heavy manipulation attempts at the SHFE open today. Visible, documented, flagged in real time by people tracking the order flow. The exchange responded by suspending the accounts involved. That's not a conspiracy theory. That's the exchange itself confirming the manipulation was real enough to warrant action. 23 suspensions in a single month. Verify that yourself. Now the settlement picture, because this is where the pressure is most concentrated. March open interest as of Monday sits at 37,651 contracts. That's 188 million ounces of paper silver heading towards settlement in 3 trading days. Registered COMEX silver, the metal that is warrant issued and actually available for delivery, sits at 88 million ounces, roughly 2 to 1. 2 ounces of paper for every 1 ounce of deliverable physical. The roll is underway. May open interest has jumped significantly as longs have moved out of March, but not fast enough to eliminate the delivery pressure entirely. February 26th is the last safe day to roll March futures positions if you want to avoid physical delivery risk. February 27th is first notice day. From that point, shorts can begin issuing delivery notices, and any remaining long positions are at risk of being assigned. No debate, the clock is running. What's important to note, and this is the honest read, registered silver has remained essentially flat to slightly down in recent days. No meaningful new metal is flowing into COMEX vaults to replenish the registered category, and there's one more signal worth watching closely. The carry-adjusted basis between March and May futures. Right now, the market is tracking whether the March to May spread flips from contango into backwardation. In normal markets, futures further out in time trade at a premium to spot. That's contango, reflecting financing and storage costs. When that flips, when nearby silver trades at a premium to future silver, it's called backwardation. And backwardation in a physical commodity market sends one message. I don't care what the paper price says. I need physical silver, now. We are not confirmed in backwardation yet. If that flips, it changes the conversation entirely. Check the CME data yourself. Jim Rickards in Currency Wars described physical commodity market stress as the point where financial warfare becomes visible, where the paper construct that normally manages price perception starts to crack under the weight of real-world demand. That's not a theoretical framework right now. That's a description of what's happening in real time between Shanghai at 96 and COMEX at 86. Now zoom out, because the geopolitical layer underneath this isn't getting simpler. Crude oil moved to $67, the highest level since August. Bullish bets on oil are surging. The question being asked in commodity markets right now is whether positioning is happening ahead of a potential Iran escalation. Global oil discoveries have dropped 40% over the past decade, from an average of 10 billion barrels per year between 2015 and 2020 to 6 billion between 2021 and 2025. That is a structural supply problem with a 20-year lag before new exploration produces first output. When oil moves on both geopolitical risk and structural supply concerns simultaneously, it adds an inflationary input into the same macro environment, already driving gold and silver higher. The import data out of India just confirmed another record month for gold. That's not an isolated data point. It's part of a consistent pattern. Eastern physical demand has been running at historically elevated levels for months, while Western financial media continues to attribute gold's rise to vague notions of momentum. Mainstream analysts don't have a framework for why spot gold is trading at $5,130. They call it a bubble. They call it speculative excess. What they don't understand is that the capital is flowing because institutions and sovereign buyers in Asia are making a deliberate, quiet judgment about where real value resides. Anyone who actually verifies the World Gold Council data, the Indian import numbers, or the Chinese ETF flow data understands what's happening. The mainstream narrative is still looking for an explanation that fits their existing worldview, and missing the structural shift entirely. Now, the honest case for caution, because balance is what separates analysis from promotion. The Shanghai session today showed something instructive. Silver opened at 99, hit 102, and closed at 96. It did not hold the 100 level. Price discovery was volatile and ultimately settled lower than the open. That tells you there is real selling pressure at these levels. Not just manipulation, but genuine participants willing to take profits or reduce exposure above 100. The implied volatility reading of 134 cuts both ways. The same explosive potential that points upside can produce equally violent downside moves if a coordinated intervention, a margin call cascade, or a broader risk-off event forces selling across asset classes simultaneously. And Western spot sitting at 86 while Shanghai closes at 96 doesn't automatically mean Western prices close the gap upward. It could mean Shanghai comes back toward Western levels if physical demand signals don't sustain. Humphrey Neal wrote in Tape Reading and Market Tactics that the tape tells you what is happening, not when it finishes happening. The structural story is written in the data. The timeline is written by the market itself, on its own schedule. Here's what the data is actually saying right now. Shanghai closed at 96 with a $10 premium to Western spot, and the final physical lot cleared at 102. COMEX implied volatility is at 134, the highest since the January spike. 188 million ounces of paper silver are heading into settlement in 3 trading days, with 88 million ounces available. No new metal is entering COMEX vaults while the drain continues. India is printing record gold imports. The SHFE suspended 23 accounts for manipulation in a single month. The carry-adjusted basis between March and May is approaching a potential backwardation signal that the informed minority is watching very carefully, and Western price is sitting at 86.40, below a resistance zone it has now rejected 3 times. The paper price and the physical market are not telling the same story. They have not been telling the same story for weeks. At some point that gap resolves. Whether it resolves this week, this month, or over a longer time frame, that is the open question. What isn't open is the direction of the structural pressure. Verify the CME volatility data. Check the COMEX reports. Look at the open interest numbers. And when you do, separate what the data is actually saying from what you want it to say. That distinction is where most people lose money. Not because they read the wrong data, because they read the right data through the wrong lens. This is financial warfare education, not advice. Protect your capital. Manage your emotions as carefully as you manage your positions. The ones who do both, who read the data clearly and stay disciplined when the market gets loud, those are the ones still standing when the dust settles. Do your own due diligence. Invest with logic, not hype.